So let us start the new topic, a new topic, profits and gains of business or profession. This is my third head of income after salaries and house property, though I have already covered with you my fourth head of income, capital gains. So let us start with this head of income, PGBP, profits and gains of business or profession. After this salary, PGBP is considered as one of the most relevant and widely used topic, because every person who is a businessman, whether that person is an individual or a company, has to follow the provisions of PGBP. If Tata Motors is one employer where there may be 50,000 employees who are working, so Tata Motors must be preparing the or must be computing the taxable income as per the provisions of PGBP. So every company must be preparing the P&L account as per the provisions of PGBP for the purpose of payment of tax to the government of India, especially income tax, not GST, income tax. We also prepare P&L account as a businessman or as a company who is in business. They also prepare P&L account as per the provisions of Companies Act 2013. But the way and calculation of that P&L account, which is prepared as per Companies Act 13, might be different from the provisions of Income Tax Act 1961. So there are chances that the profit which I have calculated as per the provisions of Companies Act 13, the profits which I have calculated as per the provisions of 2013 might be totally different from the profits which I have computed as per the provisions of Income Tax Act 1961. Because both these ways under different acts shows different calculation. One expenditure might be an expenditure as per the provisions of Companies Act 13, but the same expenditure might not be treated as a valid expenditure for the purpose of Income Tax Act 1961. So technically I need to prepare as a businessman, I need to prepare. And when I say I doesn't mean only individual. I can be HUF, I can be a firm, I can be a company, anyone who is into the business, who has to follow the provisions of PGBP under the Income Tax Act 1961. So I means businessman, a person who has to follow the provisions of PGBP. So I need to prepare two P&L accounts. One as per the provisions of Companies Act or maybe other acts, and another one as per the provisions of Income Tax Act. The P&L account which I will prepare as per the provisions of P&L Act is having only one purpose, just to compute PGBP income for the purpose of computing total income. That's it. This is what the purpose of P&L account, which I prepare as per Income Tax Act 1961. This PGBP income will be added in my all other heads income so that I get total income, and on this total income I will compute the tax to be payable by me to the government of India. So this P&L account has only this purpose, the purpose is what? The purpose which helps me in computing correct total income as per the provisions of Income Tax Act and correct tax liability. P&L account which I might have prepared as per the other provisions of the Act, and not only Income Tax Act, that other provisions means those are different acts, Companies Act, Limited Liability Partnership Act, or whatever. So that has no relationship with the Income Tax Department. Income Tax Department is a separate identity, and other acts must be giving some special identity to other people. Income Tax Act goes separately. So there should not be any question that why I prepare two P&L account. Simple, Income Tax Department has its own way to compute the profits. That's it. So you have to prepare separate P&L account. Is this discussion a little bit clear? If yes, please raise your hands. Okay. So one thing is sure that now whatever P&L account I am preparing, that has no relationship with the P&L account as per the provisions of other acts. Other acts means acts other than Income Tax Act. So technically there will be a duplication. Technically my efforts are a little bit increased. As a businessman, I have to put some more efforts in doing two things for the same point. I want to compute the profit, and for this I need to give some more efforts. My accountant or whosoever is my tax consultant, I will hire that tax consultant just to prepare the P&L account as per the provisions of Income Tax Act. A simple accountant who has no relationship with the tax provisions might prepare another P&L account as per the provisions of other acts. So technically I have to do two things. I will prepare, if I am a company, if I am Kotak Mahindra, for example, if I am a company, my efforts are increased in what way? That my consultant who is uh, engaged by me in preparing my final accounts will prepare the P&L account as per the provisions of Companies Act, as well as the same person I can assign to prepare the P&L account as per the provisions of Income Tax Act. Please raise your hands if it is clear. If this discussion is clear, please raise your hands. Okay, so now the provisions which I will discuss with you, these are totally different from the provisions which you might have studied in your accountancy, which you might have studied as accounting standards. Like in accounting standards, my calculation of depreciation might be totally different from the calculation which I will tell you now, because when I am with you, then you should leave your accountancy concepts behind and you should think that you are totally into a different world where different provisions of computing profits are applied. So when I am discussing something with you, I only discuss those things as per the provisions of Income Tax Act 1961. So I will show you the different provisions that you might not have studied, or that might be total in conflict with the provisions which you have studied in your accounting standards or in other acts. So let me show you first the act, and let me show you from which section we will start PGBP and at which section we end PGBP. So let me share with you the website of the tax department. This is my chapter 4, computation of total income as per the provisions of IT Act. And in this, I will start from section 28 when it comes to PGBP. This is what my section 28 is. Profits and gains of business or profession. Okay, this is what section 28 is. Till section 28, the topic house property was going on. So from section 28, PGBP starts and it goes on till See a long list of section in PGBP 28, 29, 30, 31, 32, 38, 2A, 32A, B, AC, AD, 33A, AB, ABA, AC, B, 34, 34A, 35. Long list 35 ABA, 35 A double B, AC, AD, B, etc. CCA, CCB, CCC, CCD, D double D double DA, E 36, 37, 38, 39, 40, 40A, 1, 2, 3. 43A, 43 double A, 43B, C, CA, CB, D, 44, 44A, double A, AB, AC, AD, ADA, AE, AF, AB, A double B, ABA, BB, BC, D, DA, long list till section 44 DB. So PGBP technically starts from section 28 and it goes on till section 44 DB, and you can see that from section 45 our capital gains started. So we have a long list of sections. Every section is not in our course. We have limited sections. So that I will tell you. So the purpose was to show you the provisions of the Act as far as PGBP is concerned. So let me start with you my main section, which is the foundation of every head. 28. I'm not at all covered under section 28, then there is no need to read other sections of PGBP because section 28 tells you whether your income is taxable under the provisions of PGBP or not. 28. Profits and gains of business or profession. So what is the foundation or heading of 28? The following income shall be chargeable to income tax under the head profits and gains of business or profession. So it gives you so many clauses. If my income is covered under these clauses, only then I will read the provisions of PGBP. Otherwise, there is no need to read the provisions. So for me, only my first clause is relevant. Clause 1. Any profits and gains of any business or profession which was carried on by the SSC at any time during the previous year. For our level, only this much is sufficient. Every businessman has to compute the income under the head PGBP as per the provisions of clause 1 of section 28. That's it. So other different examples are also given. Any compensation, any income from trade, profit on sale of license, cash assistance, custom duties repaid. So many things are written. This clause is also relevant. 28 clause 5. Any interest, salary, bonus, commission or remuneration by whatever name called due to or received by a partner of a firm from such firm. Now, I will tell you this later on. I will make you understand this clause later on. Don't get confused with the word salary. Just because I am receiving salary, it does not mean that I will include the income under the head salary. When a partner receives salary from the firm, when a partner receives salary from partnership firm, then that salary is not salary income, because between a firm and a partner, there is no employer-employee relationship. Firm and partners are not having any employer-employee relationship. Technically, partner is the owner of that firm. So that salary is not the salary technically. Interest, that interest is not income from other sources. Whatever a partner receives from the partnership firm, that is always treated as PGBP income as per section 28 clause 5. Detailed discussion we will do later on, but I wanted to give you a little bit idea that just because the word salary is there, don't add it under the head salary. Read carefully who receives the salary and from whom. If a partner receives salary from the firm, this salary is PGBP income. So many other things are written. That's it. That is theory only. You have to learn any 4 or 5 such incomes which are taxable as PGBP income under section 28. Then section 29, next section, tells you how to compute the income. You can see the heading. It is only 3-line section, or in fact 1 line. How you compute? So it only says you will compute the income as per the provisions which are written in remaining sections of PGBP, starting from section 30 to 34, sorry, 243D. It only tells you that you should compute as per the coming sections. And then different sections start. So this is my first section which tells me which expense is allowed to be debited or which expense is to be deducted from sales. This expense is that expense which is valid as per the provisions of Income Tax Act. So what will be my job in discussing the topic of PGBP? I will simply tell you those expenses which you can deduct from your sales. That's it. Otherwise, I have no other purpose. I will only tell you those expenses which are allowed to be deducted as per the provisions of Income Tax Act from your sales. So the difference is either your business income or business loss. If you see closely section 31, these all are expenses: rent, rate, taxes, 31 repairs, 32 depreciation, 32A investment allowance, 32AB deposit account, investment, etc., etc. These all are my expenses. Please raise your hand if the structure of PGBP is a little bit clear in your mind, that first of all income must be included as per section 28. Then as per section 29 you need to compute the income. How you compute that now I will tell you. Is the structure of PGBP clear now? So let me start sharing with you my screen now. Profits and gains of business or profession. So I'm starting this now. And as I told you, the P&L account is the purpose. That's it. This is what the purpose of PGBP. I need to prepare P&L account as per the provisions of Income Tax Act. If I say IT Act, don't treat it as Information Technology Act, since I'm a teacher of tax. So if I use IT Act, I am using it as Income Tax Act. And this P&L account will give me PGBP income. It can be positive or it can be negative. It is possible that I am having the P&L account as per other acts. Might be Companies Act, might be Limited Liability Partnership Act, etc. Other acts. That P&L account must be giving me net profit or net loss, but I am not concerned about that P&L account. It is none of my business to be concerned about that P&L account. I am concerned about these provisions. First thing. So what options I am having now? So what option I have if I want to prepare this P&L account? What option I am having? Option number 1, that you prepare new P&L account, fresh P&L account as per the provisions of Income Tax Act 1960. And this is first option, that if you already have P&L account, suppose you already have P&L account, you already have a P&L account, leave that account. Don't see what is written in that P&L account. You prepare a new P&L account. This is option number 1. And what is option number 2? That from already available P&L account, and this already available P&L account is not as per the provisions of IT Act. From already available P&L account, if I say already available, what do I mean by this? That is the P&L account prepared as per other provisions or as per other acts, prepared as per other acts. Suppose you have this P&L account, take its, that already available P&L account, take its net profit oblique net loss, whatever that other P&L account as per other act is showing, and make suitable modifications. And make suitable modifications as per the provisions of, can you tell me what I will write here? As per the provisions of, what logically I will write here? As per the provisions of which act?
Income Tax Act 1961.
As per the provisions of IT Act 1960. That means what I want to say, that take net profit oblique net loss as which is available with me as per the P&L account prepared as per other acts, plus do some modifications, rectifications or corrections as per IT Act, and the result will be what? PGBP income, positive or negative as per IT Act. So I have these two options. Can you tell me which option is more suitable? Can you tell me which option is more suitable? Can you think logically which option is more suitable?
Sir, I think second.
Yes, your voice is not coming.
Sir, I think option 2.
Okay, any other answer? Okay, you might not be in a position to tell me the correct answer right now. Option number 2 will be more suitable. If someone has already made some efforts, might be because of other acts, but how much difference can be there as per other acts and IT Act? There may be around 20% modifications. There may be around 20% modifications. 80 to 70% P&L account as per the acts and as per IT Act will be almost same. Only 20% to 30%. This much modification is only required in every P&L account. Though it depends upon question also, there might be 100% modification required, but in most of the cases as per your level, better that you go by option number 2. Take already taken P&L account, take that profit or loss and simply do modification. Simply check what items have been debited, what have been credited. Are these as per the provisions of IT Act or not? That's it. Please raise your hand if the discussion is somewhat clear. Okay, next point now. So now let us start discussing the provisions of IT Act. Introduction, or I can say my first section, 28. Section 28. It is the foundation of PGBP. Every first section of each and every head of income is the foundation. Section 15 is the foundation of salary. Section 22 is the foundation of house property. Section 28 is the foundation of PGBP. Section 45 is the foundation of capital gain, and section 56 is the foundation of income from other source. So it is the foundation of PGBP. This section gives those incomes which are taxable under the head PGBP. So I gave you one example. Any income from business or profession carried on by the SSC during the previous year. If I say previous year, it can be any previous year. So if you are computing the income of previous year 2021, you should check whether any business is being done in 2021 or not. If someone is computing the income for 18-19, that person will check whether in 18-19 business is being continued, business was done or not. That's it. So it depends upon the year in which you are computing the income. Income from business and profession carried on by the SSC during the previous year. Then any salary, interest, bonus, commission, any interest, salary, bonus, commission, by whatever name called, name does not matter. Anything technically received by a partner from a firm. These are some of the examples of names only written in the act, because most of the things which a partner gets from the firm is only in these four forms. But still act says it does not matter by whatever name called. It does not matter by whatever name called the partner is receiving the amount. Any salary into bonus commission received by a partner from the firm three, four, five, six. Now read these remaining any points from the act yourself, self-study. As I told you earlier, also the purpose of giving some points for self-study is to make you independent, so that you also apply your mind and learn some things on your own. Read from the act available on the website of Tax Department, Income Tax Act, incometaxindia.gov.in. Read it. Any six different points are sufficient. Next point. Now the calculation starts. Directly the calculation starts. Section 29 simply says, or it talks about computing the income under the head PGBP. Computing the income under the head PGBP as per the provisions which are given in coming sections, as per the provisions given in sections 29 to 43D. That's it. So it only says that you simply read the provisions of these sections. Now, before directly going, not from section 29, it is section 30 to 43D. Yes, 30 to 43D. Now, before going to coming sections, let me segregate these sections for you so that you remember that what we will going to be studied in these coming sections. So within section 29, I'm preparing a small chart for you, which tells you the detail of 30 to 43 due. Now I have divided these in 6 parts. Based on my experience and knowledge, I have divided this into 6 parts. These are not written in the act. This I have made so that the readers get a little bit comfortability when they read this or apply these provisions. Section 30 to 35 having different concept. Section 36 different concept. Section 37 different concept. Section 40 clause A different concept. Section 40 capital A different concept, and section 43B. This is what we need to do. In this section, all those expenses are covered which are allowed as deduction. Expenses which are allowed as deduction while computing PGBP. But all the expenses which are covered under these sections are having their own identity. These have their own identities, name. Like section 30 says insurance for building. So building insurance. Repair for plant and machinery, section 31. Depreciation, section 32. Section 75, scientific research. So these section expenses have their own identity. There may be lakhs and crores of expenses in a business, but these sections are those strong expenses which are having their own identity, own name, own conditions, and own calculation. These section expenses are required to be learned by their name, what conditions are required if you want to claim those as expenses, and how you will compute the amount which you will deduct. Then section 36. This section also contains expenses which are allowed as deduction while computing PGBP. And these section expenses are also having their own name, own conditions, but less calculation as compared to previous one. Less calculation work as compared to previous category. So these are some small expenditures, but still these expenses are also having their own identity. Like interest on capital borrowed. If a businessman borrows some amount for expansion of business or for other purposes which are valid, then that is covered under section 36. Bad debts covered under section 36. So these expenses are also having their own name, own conditions, but not much calculation. The calculation work is a little bit higher in my first category expenses as compared to section 36. But in business, there may be crores of expenses. So Act cannot cover each and every expenditure. So section 37 also constitute expenses which are allowed as deduction while computing PGBP. This section does not have any name. Expenses which are allowed doesn't have their own identity, but some common conditions are given for the expenses of section 37. That means if any expenditure which is not covered in earlier sections, such expenses are not covered in earlier sections. Which are those earlier sections? it is not covered under 30 to 35 or under 36. Those expenses can still be allowed as deduction, if the conditions of section 37 are fulfilled. So section 37 is a residuary section, you can say, for the expenses. If you have incurred that expenditure which is not allowed as deduction under section 30 to 35 or 36, there is still a chance left. It might be allowed under section 37, but provided you satisfy the condition. You means that expenditure. Now I'm using this you for this expenditure. That expenditure must satisfy the conditions given in section 37. If the conditions are satisfied, then that expenditure can also be allowed as deduction. Please raise your hand if these three categories of expenses are clear. Hurry up, please raise your hand if a little bit of this category is clear. It helps you in learning the provisions of PGBP or how structurally or systematically we will proceed in PGBP. Okay, next point now. Then section 40 clause A. I hope the screen is visible. 40 clause A. This section covers some payments which are allowed as deduction. But provided those are those payments on which you were supposed to deduct tax at source. So before discussing 40 clause A, let me simply make you understand one point. There is no need to note down this point. You take an example. Suppose I am working in any institution. And this institution gives me salary. This institution is giving me salary. So can you tell me when this institution, suppose it is not an educational institution, when this institution is preparing P&L account, where this institution will show this salary given to its employee, who is Mr. Naveen?
Debit side.
Expense. He will say, this institution will say that we have incurred some expenditure, salary to employees. Maybe this institution has purchased something from Mr. K. So Mr. K supplied something to this institution, some goods to the institution, and this institution, so Mr. K supplied goods, and the institution will give to Mr. K what? Can you tell me what this institution will give? What this institution will give to Mr. K?
Sir, payment.
Payment, yes. Very good. Payment. So where I will show this payment? Can you tell me where I will show this payment?
Trading.
Trading or P&L account. If I am saying P&L account, you treat it as trading and P&L. Okay. For PGBP, we are only preparing P&L account, so it is trading and P&L. Now, where I will show this?
For expense.
As an expense. This payment is my expense. Expense related to payment on purchase of goods. or you can write purchase of goods, whatever you want to write, it's your choice. Now, to keep audit trail, to keep transactions in record, what department has given? Department has given some provisions of TDS, tax deducted at source. This TDS provisions not only help in audit trail, but also helps the department. It also helps the department in receiving the tax, regularly. This also helps the department in receiving the tax regularly, because tax is normally paid on yearly basis. I will pay the tax after 1 year. So if this Mr. Naveen is an employee, whatever salary he will earn, he will pay the tax. There is no problem, but he will pay after 1 year. But monthly basis, on every month, when this institution give this salary to Naveen, institution deducts tax at source. If, for example, this institution is giving 1 lakh rupees to Naveen per month, this institution might deduct 30,000 rupees as tax, and this institution will say that we will give you 70,000, because 30,000 is your tax which we are paying to the government in advance. It is nothing but TDS, tax deducted at source. At source means the level where that amount or payment is required to be made. So in this way, government received 30,000 today itself, which I would have paid as Naveen after 1 year, or when my year ended. This is the benefit of TDS. It also helped in audit trail. So there will be in the record of the department that this person Naveen earned some income. So 30,000 is the tax which we received as advance. Same is the case in payments. When I'm making this payment to Mr. K, suppose if 5 lakh payment is required, might be as per the provisions of TDS. For TDS, we have separate provisions in the Income Tax Act. Might be I'm supposed to deduct 1%, for example, or 10%, 50,000 as tax. Might be. So I will deposit 50,000 as tax on behalf of Mr. X to the department. So this TDS provision is helping me means department is helping the department to collect taxes on time, because department, ultimately government, this tax amount goes to the government has to incur so many regular expenditure, regular salaries, regular park, regular highways, regular buildings, regular pensions. So many expenses are required. Government cannot wait for 1 year to give these expenses, because expense incurring is a regular phenomenon, and that is why income must also be regular. That is why TDS provisions are very helpful to the government. Now, suppose in this case, when this institution is giving me 5 lakh, suppose as per the provisions of TDS, as the payer of the amount, I am paying the amount 5 lakh to Mr. K. I was supposed to deduct 50,000 tax, but I failed in deducting tax. Suppose the institution failed in deducting tax and paid the entire amount of 5 lakh to Mr. K. Though legally I had to deduct 50,000 tax, I should have paid only 4 lakh 50, but I paid entire 5 lakh rupees. By mistake, I failed. Then section 40 clause A will restrict me to deduct this expenditure. It might restrict me. Technically, you need to read 40 clause A, but I'm giving you an idea only. It will restrict me that I will not now in a position to debit 5 lakh rupees. What will be the effect of this? My profit will rise, because less is the expenditure, more will be the profit, and I will have to pay more tax now. That is why every businessman takes great caution in deducting the tax at source, so that that expenditure which is genuine is allowed to that businessman as a valid expenditure. So 40 clause A talks about those expenses or those payments which are subject to TDS provisions, which are subject to TDS provisions, the provisions of TDS, if these are applicable. and it will tell you when the expenditure is disallowed or when the expenditure is not allowed to be deducted, not allowed to be deducted while computing. Business PGBP. That's it. 40 clause A covers those payments or expenses which are subject to TDS, and it will tell you in which situations these cannot be debited while computing your PGBP income. That's it. So 40 clause A basically covers expenses on which TDS provisions are applicable. Now 40 cover A technically will be covering only these expenses. First of all, an expenditure must be covered under these sections to be a valid expenditure. Once any expenditure has satisfied these sections 30 to 35 or 36 or 37, that is allowed. But from those expenses, you have to carefully check, is that expenditure that on which TDS is applicable? If yes, then your effort is a little bit extra. You have to read one more section before debiting that expenditure. There may be an expenditure which is valid as per section 37, for example. But if that expenditure is that on which TDS provisions are applicable, then along with 37, read 40 clause A also, and then only take a decision whether that will be allowed to be shown on the debit side of P&L account or not. Please raise your hand if the concept is clear. If an expenditure is not at all covered in section 30 to 35, 36 or 37, there is no need for me to apply the provisions of section 40 clause A. To apply 40 clause A, first of all, that expenditure must be a valid expenditure. So once it has crossed this barrier, 30 to 35 category or 36 or 37, only then I will apply section 40 clause A. But if some expenditure is not at all covered under 30 to 35 or 36 or 37, there is no need for me to check section 40 clause A. I will only check it if that expenditure is allowed as deduction, and if TDS is applicable, only then I need to check 40 clause A. Otherwise, if an expenditure is not at all covered under 30 to 35 or 36 or 37, why will I apply section 40 clause A? Please raise your hand if what I have said regarding 40 clause A is clear in your mind. Any doubt, you please ask, otherwise raise your hands. Next point. 40 capital A. This section also covers the expenses on which there is no TDS provision, but because of some conditions, these are not allowed to be deducted. These are not allowed to be deducted while computing PGP. Here also the same thing. First of all, these expenses must be those which are covered under any of these categories. Once an expenditure has passed the test of 30 to 35 or 36 or 37, then it is possible that I need to check something extra. 40 capital A talks about those extra conditions, like, just let me tell you some example. In this payment to relatives is concerned. Payment to relative, this is one point which is mentioned, payment to relative. Suppose if my brother is I'm a businessman, if my brother is also a businessman, and we two have different shops, I am a purchaser of some raw material from my brother and I will make the payment. Government says there is no problem. You are purchasing something from your brother. Just because you are purchasing something from the brother, it does not mean that you are doing anything illegal. That payment is allowed, there is no problem. That purchase is valid, but it should not be unreasonable. If that product, the same raw material, is available in the market for 1 lakh rupees, and you are purchasing the same raw material from 1 lakh from your brother for 1,20,000 rupees, then 40 capital A says that 1 lakh is valid, but whatever payment you are making to your relative, which is unreasonable, that is not valid. So what example I have given you here, I am a businessman. I am preparing my P&L account and I made some purchases of 1,20,000 from my brother. Just because I purchased something from my brother, it doesn't mean that it is wrong. So it is allowed. But 40 clause A says, carefully check. If you are making the payment to your relative, just because you are purchasing the material from your relative, payment should not be unreasonable. How do we decide unreasonable? That is another course of study. Suppose in the market the same product is available at 1 lakh, then why you are paying 1,20,000? So then 40 clause A says that extra 20,000 is paid is invalid. So what I will do, I will prepare new P&L account and I will not show 1,20,000, I will show 1 lakh rupees. This is what the provisions of, these are what the provisions of Income Tax Act. 40 capital A covers also the expenses on which we have some extra condition to be checked. So I gave you some example only. So 40 capital A says that, first of all, this is sure, just like 40 clause A, that all the expenses which I am reading, which I will read for 40 capital A, these must have passed the test of section 30 to 35 or 36 or 37. Only then they will reach to 40 capital A. Once any expenditure is failed in these first three categories, then there is no need to read 40 clause A or 40 capital A. Once the test of expense validity has been passed with respect to any expenditure, then you need to carefully check, is that expenditure needs extra section to be checked? Extra section to be checked is 40 clause A or 40 capital A. So this section tells you the expenses which are not allowed to be deducted while computing PGBP. Why not allowed? So this section will be having different conditions that I will tell you later. Similarly, 43B. This is also the, technically this will also tell you something which is not allowed, but it also says that once any expenditure has passed the test of 30 to 35, 36 and 37, then it is possible that you need to carefully check one another section 43B. This section allows the expenses only when you actually paid it. Just because these have become due, you cannot claim that deduction. Actually paid. If not actually paid, not allowed. So these are allowed only if actually paid. Only if actually paid by you. Just because these have become due, you will pay next year. Government says no. You paid it only, then you claim it. Otherwise, don't come. If allowed, if actually paid. So same is the case here. 43B also covers those expenses which have first passed the test of either 30 to 35 or 36 or 37. Once they have passed the test of any of these three categories, then I need to carefully check, is this expenditure also covered under 43B? If yes, then I need to check, have you actually paid it? If paid it, only then claim it as deduction, otherwise not allowed. So what I can say is, first three categories basically covers those expenses which can be shown on the debit side of P&L account. But all the expenses which are covered in any of first three categories, for every that expenditure, carefully check whether this is covered under section 40 clause A also, or 40 capital A also, or 43B also. If covered, check that respective section 40 clause A or 40 capital A or 43B. If that respective section conditions is also clear, only then you deduct it as an expenditure, otherwise not. So what I can say now is any of the expense, whether of 30 to 35 or 36 or 37, any of the expense must be carefully checked. That means you apply one additional condition of 40 clause A if applicable. It's not compulsory, if applicable. 40 capital A if applicable. 43B if applicable. So two stages you need to check for every expense before you debit that. So before you debit any expenditure, first check this stage, stage 1. Is it covered or is it allowed as deduction as per any of these sections? If okay, then you go to this stage 2. If it will bypass the test of this stage 2, only then you debit it, or only then it is allowed as expense, as an expense. Simple. Only then you can debit this on this side. If there is some expenditure which passes this test of stage 1, if stage 2 applicable but failed in stage 2, then you cannot debit that. Any expense, if passes the condition stage 1 passed, okay. Stage 2, first check, is stage 2 applicable on that? Applicable on that? If yes, then check, is stage 2 also passed? No. Then what is the net result? Can you tell me what is the net result?
Sir, not debited in P&L account.
Not to be debited in P&L account. Stage 1, okay. Stage 2, applicable? No. If not applicable, there is no need to check stage 2. What is the net result? Allowed as deduction or not?
No, sir.
Yes. If stage 1 okay, and if stage 2 not applicable, then I'm not concerned about stage 2. Since stage 1 is clear, you deduct it. Any expenditure stage 2 not passed, sorry, stage 1 not passed, then I'm not concerned whether this stage 2 is applicable or not. It is not allowed. So if any expenditure is passed at stage 1, then check, is stage 2 applicable? If yes, and if not clear the stage 2, not deduct, do not deduct. Stage 1 passed, check stage 2 applicable or not. If not applicable, then stage 2 doesn't matter, it is allowed as deduction. Stage 3, sorry, category 3, stage 1 not passed, it failed. So these are different illustrations which I am discussing. Illustration 1 concept, illustration 2 or illustration 3. In illustration 3, what I'm saying is that any expenditure stage 1 failed, no need to check stage 2. Result, you cannot claim it as deduction. This is the structure of entire PGBPs. After this, I'll be having some other special sections also. The topic is not complete at these 3 categories. Then we'll be having some other special sections. Those I will discuss those later on when we will wind up these 6 different categories. That's all for today's discussion. In case you have any query, please ask. After this, I will end the discussion. Please ask if you have any query or raise your hands if the concept is little bit clear. More practice will come, more confidence will come when we'll start discussing the expenses. But is this structure theoretically clear in your mind? If yes, please raise your hands.
Excuse me, sir.
Yes.
Sir, it is from section 30 to 43D or it is 43B?
43B के बाद भी काफी sections हैं.
Okay, sir.
Any other query? Okay, so this is first theoretical discussion on the topic PGBP. Next, in the next class, I will start discussing with you expenses now one by one. So in my next class, I will start with my first category of expense, section 30 to 35. First class will be section 30, then 31, 32, etc. So in the next class will be of around 2 or 2.5 hours on Thursday that I will tell. That's all from my side. And I expect that by Thursday you wind up your capital gain. Don't leave it. And don't depend on only marks in the examination. You must be having the confidence in your knowledge. The hard work which you will do now, it might give you the result maybe after 5 or 6 years. So just don't run behind the marks, run behind the conceptual knowledge. You must wind up your capital gain by Thursday, because from Thursday onwards we will be having the workload of PGBP. So I'm leaving a little bit free. I'm leaving you a little bit free for tomorrow. Otherwise, also I would have taken the extra class. But I am giving you time to wind up capital gain by Thursday evening. That's all from my side. Goodbye.